Hello and welcome to the very special coverage of Policy Day. In a few minutes from now, we're going to be hearing from the RBI Governor, Mr. Sanjay Malhotra himself, in terms of what the outlook is, what the stance is going ahead. But before that, the street is largely expecting no action this time around. Let's interact with our panel of esteemed guests that we've got on the show and start introducing them one by one. We've got Ms. Radhika Rao, Senior Economist and Executive Director at DBS Bank, joining us. We've also got Astha Gudwani, India Chief Economist at Barclays, and joining them on the show is Tanvi Gupta Jain, Chief India Economist, UBS Global, and we've got a whole bunch of panelists joining us. So good morning to all of you. And Radhika, let's begin with you. What is your outlook on what the tonality of the policy could be? And before that, more importantly, what do you think the verdict is going to be?
I think this central bank policy meeting, we're expecting a pause, and I think that's very much where the consensus is at this point. I think the central message is going to be that their pause should not be interpreted as complacency. I think they are signaling patience, which is to say that yes, inflation is more than at a year's high. We've seen food prices, for instance, pick up. There is still the geopolitical uncertainty overhang from global developments. And you can see that, slowly, I think going into this quarter and the next, there could be pass-through of some of those price increases, especially from manufactured inputs into the consumer prices. But they're going to be watchful. They're going to be watchful of how, persistent this becomes, and does it become a generalized inflationary concern rather than still being purely supply-driven. I think these are the signaling that we expect. I do think that the guidance will be, again, a bit more cautious. I don't think they would go ahead with a dovish, signaling, so that market expectations, inflationary expectations, all of them remain anchored. Insofar as the economic assumptions are concerned, we really don't expect any changes for now. But when you look at the numbers, I would say growth has upside risks compared to what their last assessment was. We are, at 6.8% with upside risks still. The GDP number that's going to be coming out, we think it's going to be relatively firm. So in terms of bias, I would say growth expectations or growth forecasts could be revised up, could be this time around or when they meet next. But insofar as the stance is concerned, insofar as the decision is concerned, we are looking for no change at today's meeting.
Tanvi, hi, morning. Do you see a change in the inflation trajectory there? The governor would be looking at more growth-oriented or maybe to curb inflation?
I would say this policy will be a little too early to actually change either the inflation forecast or the growth forecast, because we did see only in the last policy that the growth forecasts are revised down, inflation forecasts are revised up. So I would say they will be more in the wait and watch mode. I mean, they are tracking, and I'm sure they are tracking how the rainfall progress has been. I mean, we definitely are getting comfort from the fact that the rainfall activity did improve in the month of July. I mean, from a deficit of 40% deficit that we saw in the month of June, now we are sitting at 12% below normal rainfall. Crop sowing, which was down 21% early July, is now down 3% end of July. So I think too early to look at the numbers. But when I look at our UBS forecast, we actually have a 4.8% inflation forecast for FY27. I would say if at all they have to make a change, RBI will have a much more clearer picture by the next policy in October. I think that will be the time to either upgrade the GDP growth forecast or, lower the inflation forecast, depending upon how the monsoons would have shaped up by then.
Okay, your inflation forecast is 4.8%. Basis the last meeting, the governor's speech, he did say for FY27 the target is 5.1, for CPI and core CPI 4.7. So we'll be watching out for if there are any changes on that front. But Astha, hi, welcome to the show as well. Radhika did say that we're expecting to see some changes in the GDP number. Given where we are from the last policy meeting, crude prices have also significantly come down. The FY27 guidance for GDP given by the RBI was 6.6%. Forecast would be the correct word. Where do you see this number now? Because we have seen crude prices come down. The June CPI number also has more or less been stable. What's your outlook over there?
Sure. So I think on crude prices, let's still sort of hold back. Today it's at 78, but just about a week ago, we were again going back to 100 levels. I don't want to predicate growth assumptions depending on today's crude oil price, but I do believe that there are sizable upside to the growth print that the RBI has come up with. RBI has it at 6.8, 6.6. We have it at 6.8 ourselves. And I would agree with Radhika that we expect growth outcomes to generally come in on the higher side versus RBI's expectations. The first quarter GDP print for the financial year that will come out in early September will be a good time to reevaluate the growth trajectory for the full year. But I would expect an upward revision, if not today, then in the upcoming, the October policy by the RBI.
Asta, the other thing was the currency, forex. The measures taken in the last policy. It seems that it's getting enough flows coming in. Do you think RBI will have a commentary on that as well?
So I think RBI did, it was almost like a whatever it takes moment that the RBI announced in June when they released a slew of measures in close coordination with the Ministry of Finance. And credit where due, the kind of flows that we have seen coming in so far are quite healthy. The fact that the FCNR window is open until 30th September, the ECB window is open until 30th December, we would expect an acceleration in the pace of these inflows going forward. I think these foreign inflows at the margin, especially when crude is following a gyration cycle of its own, is a great tailwind for the currency to have. We are not looking at any adjustments to the announcements that they made in June. We are not looking at any additional announcements, but I do believe that they will give an updated number of the foreign flows so far and indicate how happy they are with the momentum that we have seen and expect more acceleration going forward. So I would not be expecting any additional currency response measures in this particular policy, but I do expect them to give a pat on their back given the way flows have turned out.
Tanvi, do you think the governor may advance the closure of that window, given that we have received the flows more than last time, and the more you get it, you also have to pay back. So do you have to make a reserve for that as well?
I would say in our base case, we are expecting that these measures could potentially attract some $60 to $70 billion of inflows. So right now, the number which is being disclosed by the RBI number is still 40. So I think there's still some way to go before RBI thinks about whether there's a need to prematurely let the scheme close by. Plus, we also have to understand that India is sitting on a forward book of $106 billion. So I would say this is a very different situation versus 2013 when the forward book was not a big concern. The number was less than $20 billion. So this time around, even if this number 70 goes up to say somewhere around $80 or $90 billion, I think that will be a good step. There is no need to prematurely try to close that scheme. And we also need to realize is that what we are looking right now is that the external situation is also shifting. The dollar has strengthened amid expectations of a potential Fed tightening. Oil prices continue to remain volatile. As Asta pointed out, I would not give too much weight only to today's number because we are seeing these ongoing geopolitical tensions. So I would say even the structural headwind for INR continues to remain, which is basically your need to attract higher FDI inflows, risk to IT services exports from AI-driven disruption, possible dollar strength. So I would say too early to say that there's a need to let the scheme prematurely close. I would expect at least $70 billion of flows India should be able to attract before September.
Okay, that's the